Welcome to this intelligence briefing. We're going to get straight to it and dissect three critical shifts in India's economic landscape. These are changes that will have immediate and long-term consequences for your strategic planning.
So let's start with the one number that changes everything, 18%. This isn't just another data point. You need to view this as the new anchor for the entire U.S.-India trade relationship. It signals a fundamental reset with immediate strategic implications.
So, what's happening? A new interim framework has been announced. And I want to be crystal clear here. This is not some minor adjustment. What we're witnessing is a structural shift in the economic relationship between two of the world's biggest economies.
Okay, first deep dive. Let's break down the core components of this new agreement so we can really understand the new terms of engagement.
And look, the official framing from Prime Minister Modi himself tells you everything you need to know. The language here is all about partnership, trust, and dynamism. This confirms that this move is strategic, not just economic. And that emphasis on Make in India, well, that shows a deep alignment with domestic policy priorities.
Okay, let's get into the hard data, because the numbers here are stark. The centerpiece is that tariff reset, dropping from a massive 50% all the way down to 18%. Now, critically, that 25% penalty tariff, which was tied to Russian oil imports, has been taken off the table completely. But here's the kicker. Look at the scale of the U.S. commitment. We're talking about a massive $500 billion procurement intent from India over the next 5 years.
And you need to understand, this isn't some far-off plan. The timeline for implementation is incredibly fast. A U.S. executive order is expected as soon as next week, with the full signing happening in mid-March. This signals a very high degree of political will to get this done, and done quickly.
So what's the bottom line here? It's simple. This is way more than just a tweak to tariffs. It's a strategic realignment of entire supply chains. The deal immediately restores competitiveness for Indian exporters, while at the same time signaling a very clear pivot in where India will be sourcing its critical goods, especially things like energy and defense technology.
All right, that brings us to our second deep dive. Energy geopolitics as leverage. This is where we start to uncover the unspoken conditions of this deal, and believe me, they are just as important as the tariffs.
Now here's the hard fact, and it's a big one. You've got two completely different stories being told publicly. Reports coming out of the White House are claiming that India has agreed to stop importing Russian oil. But India's Ministry of External Affairs is maintaining that its #1 priority is energy security through diversification. This kind of public discrepancy, it creates a significant risk profile.
And the context here is that penalty tariff, the 25% one, its removal is not set in stone, not at all. There are already explicit warnings that it could be snapped right back into place, and that creates some serious leverage for the U.S., and of course forces a major strategic calculation in both New Delhi and Moscow.
The strategic implication couldn't be clearer. The bottom line is this. The trade framework has now hardwired geopolitical conditions into the deal. From now on, India's energy sourcing is directly tied to its trade access to American markets. The two are inseparable.
Okay, for our third and final deep dive, we're shifting focus to a critical signal coming from the domestic financial sector. You see, the health of the country's largest lender, the State Bank of India, it requires a much more nuanced view.
So, the number you're seeing everywhere is this, 21,028 crore rupees. That's the record quarterly net profit for the State Bank of India. A huge 24.5% jump year over year. And on the surface, wow, that looks like an incredibly strong signal.
But this is where we need to read between the lines. The context here is critical. That headline number, it was significantly inflated by one-time gains, things like mutual fund dividends and forex transactions. Meanwhile, a key indicator of asset quality, loan loss provisions, actually jumped by nearly 40%. And that is a key indicator to watch because rising provisions can signal future problems with credit quality, which could tighten lending across the whole economy. So, what's the strategic bottom line? That huge headline profit number is hiding some real concerns about underlying asset quality. For anyone with financial exposure in the region, this means you absolutely have to look past the top-line growth. A deterioration in asset quality at this scale could have serious ripple effects, potentially impacting credit availability for major projects down the line.
All right, let's pull all of this together. We're going to synthesize these events into 3 overarching strategic shifts that are basically the new rules of the game going forward.
And this really lays out the new operating reality for you.
First, you've got the tariff plus procurement bundle. Trade isn't just about market access anymore, it's a package deal. Second, energy is now trade leverage, plain and simple. And third, a projected $200 billion investment wave into data centers tells us that compute capacity is being treated as critical national infrastructure. To put it simply, trade, geopolitics, and domestic industrial policy have all merged into a single strategic challenge.
And that concludes our briefing. The key takeaway is that you have to assess your own strategic plans against these new realities. So the question I'll leave you with is the one on your screen. Which of these fundamental shifts poses the greatest risk or presents the most significant opportunity for your organization?